The hardest time to invest is often the moment when everything looks too expensive to buy, but too strong to ignore. Maybe you invest every month. Then the market climbs, headlines get excited, and suddenly your normal contribution feels risky. You start asking one question: should I keep buying or wait for a better price? This question matters because it is not just about math. It is about behavior. A good plan that you can actually stick with is often more useful than a perfect plan that you abandon after 3 scary headlines. There is no single answer that fits everyone, but there is a useful way to think about it. The real question is not whether the market feels expensive. The real question is whether your plan still matches your time horizon, your risk tolerance, and your actual financial life. When people say the market feels expensive, they usually mean prices have risen a lot, or valuations look high compared with history. That feeling can be reasonable. Stocks are not always cheap, and future returns can be lower when starting prices are very high. But expensive does not automatically mean a crash is coming tomorrow. Markets can look expensive and keep rising. They can also look cheap and keep falling. Valuation is useful for setting expectations, but it is a poor stopwatch. Trying to wait for the perfect entry point sounds smart. In real life, it creates 2 hard decisions instead of 1. First, you have to know when to stop buying. Then, you have to know exactly when to start again. Most people who say they are waiting for a pullback do not have a clear rule. Are they waiting for prices to fall 5%, 10%, or 30%? And if prices fall, will they actually buy, or will they worry that a bigger drop is coming? This is where dollar cost averaging comes in. Dollar cost averaging means investing a fixed amount on a regular schedule, such as every paycheck or every month, regardless of whether the market is up or down. When prices are higher, your fixed contribution buys fewer shares. When prices are lower, it buys more shares. You are not trying to guess the perfect price. You are using a system that keeps you participating through many different prices. Think of it like buying groceries you need every month. If the price changes, your same budget buys more or less. You may not love paying more, but you are not trying to predict the exact cheapest day of the year to eat. The biggest benefit of dollar cost averaging is not that it magically beats every other method. It is that it removes some emotional decision-making. It turns investing from a dramatic event into a routine. Feeling nervous when markets are high is normal. In fact, it can be healthy. Nervousness reminds you that investing involves risk. The problem begins when nervousness turns into constant guessing, pausing, restarting, and second-guessing again. If this kind of plain English finance explanation is useful, consider subscribing. The goal here is not to predict the next market move. It is to build better tools for thinking about money decisions before emotions take over. Here is an important distinction. Being nervous is not the same as being overallocated. Nervous means you feel uncomfortable because prices are high or headlines are intense. Overallocated means you own more risky assets than you can realistically handle. If a normal market drop would make you unable to pay bills, lose sleep for weeks, or panic sell everything, the issue may not be the market price. The issue may be that your portfolio is too aggressive for your life. Before asking whether the market is too expensive, ask whether your basics are covered. Do you have cash for near-term needs? Do you have an emergency cushion? Are you investing money that can stay invested for years, not money needed next month? Money needed soon should usually be treated differently from money meant for retirement decades away. A market that feels expensive matters much more if you need the money in 1 year than if your goal is 20 or 30 years away. For long-term goals, monthly investing is often less about today's price and more about building a durable habit. The habit matters because wealth building usually depends on repeated actions, not one heroic decision. It helps to separate 2 different choices. One choice is what to do with a large amount of cash you already have. Another choice is whether to keep investing new income each month. These are not the same problem. With monthly contributions, you are investing as money becomes available. You are not necessarily choosing between investing everything today and waiting forever. You are deciding whether your normal savings rhythm should continue. When you pause because prices feel high, the cost is not always obvious. If the market falls, you may feel relieved. But if the market keeps rising for months or years, your cash may sit on the sidelines while your plan slowly drifts. Cash feels safe because its value does not bounce around on a chart every day. But cash has its own risk. It may not grow enough for long-term goals, especially after inflation. Safety depends on what the money is for. One common fear is buying right before a crash. That can happen. No strategy removes that possibility. But monthly investing spreads your entry points over time, so your entire plan does not depend on one single day. There is another fear that gets less attention. The fear of never buying because the perfect moment never arrives. Many investors imagine they will be brave during a crash, but falling markets usually come with frightening reasons to wait even longer. A useful way to think about valuation is as a dimmer switch, not an on-off switch. High valuations might lower your expectations for future returns. They do not necessarily mean you must stop completely. If your plan truly feels too aggressive, you do not have to make an all-or-nothing move. You might adjust future contributions, rebalance toward your target mix, or increase cash for known expenses. The key is to make changes because your plan changed, not because your mood changed. A target allocation is a preset mix of assets that fits your goals. For example, a person might decide what portion of their long-term portfolio belongs in stocks, bonds, or cash. The exact mix is personal, but the purpose is universal. It gives you a map before the weather changes. Rebalancing means bringing your portfolio back to its target mix. If stocks rise a lot, they may become a bigger share of your portfolio than intended. Rebalancing can reduce risk without requiring you to predict the next crash. The more emotional the market feels, the more useful written rules become. A simple rule might say how much you invest monthly, how much cash you keep, and when you rebalance. Written rules do not make you emotionless, but they give emotions less control. There are times when slowing or stopping contributions can make sense. If you lost income, have high interest debt, need money soon, or realize your portfolio risk is truly too high, then adjusting may be responsible. That is different from stopping only because a chart went up. Continuing may make sense when your emergency fund is solid, your time horizon is long, your contributions are affordable, and your allocation still matches your risk tolerance. In that case, expensive markets may be uncomfortable, but discomfort alone is not a plan. A beginner mistake is treating every market feeling as a market signal. Fear feels important, excitement feels important, but feelings are not forecasts. They are information about you, your risk tolerance, and your need for a clearer system. A simple framework is to ask 3 questions. Is this money for the long term? Is my allocation appropriate even if the market drops? And am I following a rule I chose calmly? If the answer is yes, monthly buying may still fit the plan. The goal is not to feel confident every month. Nobody does. The goal is to build a process that works even when confidence is low. Good investing often feels boring, repetitive, and slightly uncomfortable. So, should you keep buying monthly when markets feel expensive? If your plan is sound, your time horizon is long, and you are not overexposed, continuing can be a disciplined choice. If your life or risk level has changed, adjust the plan deliberately. Do not let a vague feeling of expensive become your entire strategy. What part of monthly investing feels hardest to you? Is it buying when prices are high, holding when prices fall, or knowing how much risk is right? Leave a question in the comments and suggest the next finance topic you want explained.